Welcome to Mongo Spaces this Thursday evening. And today we are very privileged to have Frank Miti, who's the NSE CEO. We're going to dig deep into the NSE and understand the history of the exchange, his personal journey to the exchange, and how the future of the exchange looks like going forward. My name is Eric Mokai. I'm the founder of Mongo Capital. I want to allow Frank to introduce himself. Maybe, Frank, you can tell us a bit about yourself and your journey to becoming the NSE CEO.
Thanks, Mukaya. Good evening, everyone. If you're in Kenya, or good morning or good afternoon, depending on where you're logging in. Maybe to start this off, as you say, Mukaya, let me introduce myself. Currently, I'm the CEO of the Nairobi Securities Exchange. I took up this role last year, so I've just finished a year and several months. Before that, I was a partner and the East African markets leader for EY, based in Kenya, but covering about 7 countries, specifically focusing on matters M&A, corporate finance, as well as strategy and business development. I joined the EY in the middle of 2019. Before that, I was based out of London, working within the investment banking space. I was in the UK for slightly over 15 years, specifically working primarily in the investment banking space, as I said, working with the clients in UK, continental Europe, US, Russia, a bit of Middle East. And then the way I got to the UK is I started my career at PwC here in Kenya, straight after university. Spent about 3 years with PwC here in Kenya, initially in the audit space, then moved into advisory, moved with them to the UK, and then I transitioned to investment banking. So my career has spanned over 25 years now, with time spent primarily, as I said, in the financial services space, as well as management consulting. Beyond that, I'm a lawyer by training, although I didn't practice law, but I'm also a qualified accountant, and so I'm a CPA. And beyond all that, I am a father of 2 lovely children. So you can hear that I've spent of the 25 years, 15 years out there, and then the remainder here in Kenya. And I guess more importantly, and I'm sure we'll touch on it, Mukaya, is why I chose to take up the role at NSE. And some of the things that I considered to transition to the NSE from my previous role, and also more importantly, how we are executing some of those reasons within our current strategy. I should also mention that while I was in the UK, I ran my own corporate finance advisory business. And part of that business had clients in sub-Saharan Africa, including here in Kenya. While I was in the UK, I interacted quite a lot, actually, with a lot of the listed companies that are now part and parcel of the NSE that I am now leading. So in many ways, capital markets is not new to me. A lot of the participants are not new to me, having interacted also with PE firms and the investment banks here. But I think there are differences, but I'm sure we'll get to that. If you want to get more personal, I was born in a small village in the mountains around Mount Kenya, in Meru. I grew up there for the bulk of my young life, and then I went to high school at a school called Mangu, and then went to university at the University of Nairobi. So I'm a true Kenyan in that sense, with that sort of experience.
A lot to pick out from there, but maybe if you can describe to people a little bit, what do investment bankers do, by the way? Because you've done that a bit.
That can be quite varied depending on whether we are talking about a full service investment bank, but it cuts across different aspects. First of all, of course, what most investment banks are known for is the market operations. So essentially trading things like listed equities, derivatives, of course, fixed income instruments like bonds, corporate paper, etc., FX, etc. So that's on the trading side of things. The other big portion within investment, properly well-developed full-service investment banks, is normal corporate finance, away from trading, in which case it's really, we are talking about supporting businesses to access capital through different types of corporate finance transactions. The other big element within IB is M&A, mergers and acquisitions, which typically works alongside corporate finance, but for M&A, typically it's buying and selling businesses. And you've seen even activity here in Kenya in that regard. Then is for well-developed investment banks, you'll also see them doing some aspects of the structured transactions that go beyond the typical corporate finance transactions. For example, teams doing leveraged buyouts, teams doing, for example, takeovers that require restructuring and turnaround. So in the distressed asset space, etc. The point is, I think depending on what sort of investment bank you're talking about, the range of services that they do is quite huge. The two big investment banks that I've worked for, so UBS, one of the largest globally, as well as Deutsche Bank. Again, UBS is a Swiss investment banking group, and Deutsche is a German banking group. These are large investment banks that have different franchises, including wealth management as well as the asset management. But I think a lot of the listeners on the call will probably be familiar with the trading side of things for investment banks. I would imagine also the M&A side of things. But again, the markets differ. I guess I have my own view on where the investment banks in Kenya are in terms of their maturity. But suffices to say that a lot of times, some of these services, you can access them in our markets either way. In any event, Mokai, I think you're aware that some of the bigger players are now in our market. JP Morgan is here now. Of course, you have Citi as well, although I think a lot of the work that Citi is doing in Kenya is probably less about investment banking and more about corporate and sovereign banking. And then also you have other players that are also quite sizable. For example, Stanbic, given the larger parent in South Africa, which has quite a sizable investment banking franchise as well. We can talk a lot more on that, Mukaya, but that's part of it.
I just wanted to put that in context of NSE and capital markets generally in Kenya. So maybe you can give us a bit of a brief on the Nairobi Securities Exchange and what's their role in the capital markets, and generally what do they do in the Kenyan markets. If you also can give us a bit of a brief history of the exchange, would be really lovely.
Let me start by saying NSE, the Nairobi Securities Exchange, is one of the oldest exchanges in Africa. We celebrated our 70-year anniversary last year. The NSE, as you can hear, dates back to pre-colonial times. It was set up initially as a chapter of the London Stock Exchange, and then with time morphed into a local association, and then back in 2014 demutualized to become a corporate entity and subsequently listed itself on its own exchange. So as we sit today, the Nairobi Securities Exchange is a public listed company. The listeners here can actually buy shares on the NSE itself, like you would do on a lot of other listed companies, Safaricom, KCB, Equity, etc. And what that means is that NSE, as it sits from a corporate perspective, it has different dimensions. One, as I said, is a public listed company with the ownership that's spread across both local as well as foreign investors. The government of Kenya does have a small stake, 3.36%. Otherwise, the rest of the ownership sits within private shareholders, both the domestic as well as foreign. Number two, the NSE also is a regulator, a first-line regulator. Regulatory responsibilities are delegated to us from our primary regulator, the Capital Markets Authority, CMA. But what that means is that, and we'll talk about that in a bit more detail, but what that means is that we have regulatory powers to oversee various actors in our market that interact with the exchange. For example, we have brokers, we have potentially, depending on what's happening in the market, some transaction advisors, etc. But the primary regulator is CMA, and then we have delegated powers to regulate. And of course, we also have the powers to oversee some of the entities that are listed on our exchange. The other thing I think to mention is that NSE is a full service exchange. What does that mean? It means that we offer several types of products on our exchange. Let me mention a few. Of course, we have equities, so listed shares, as it were, of companies. I think most of the listeners here, if not all of them, will already be familiar with that. Then we also have bonds. You can trade bonds on our market. Those could be both corporate bonds as well as treasury bonds. Bulk of our bonds business, the trading of government treasuries. Currently, as we sit, NSE is the only exchange, I should say, where secondary trading of treasury bonds, government paper, is available, including, of course, infrastructure bonds as well. But within the fixed income space, bonds, commercial paper, and other debt instruments ideally would fall within that category. We also have structured products, for example, real estate investment trusts that are available in our markets. We also have ETFs, exchange traded funds. You will recall that we recently listed the MSCI World Feeder ETF that provides investors with access to over 23 developed economies in Europe, US, and Asia. And more specifically, also gives you access to more than 3,298 shares in one instrument. But the point is that we have structured products. Then we also trade derivatives, single stock futures. We also have gotten approval now to also offer options. And what is interesting there is that the bulk of our derivatives business is actually retail investors as opposed to institutional investors. And then we have other non-trading solutions, being a full service exchange. For example, we provide capital markets related consulting services. We also sell data, which is a big business for exchanges, as well as other curated programs, such as the NSE Booker, which is a program to support SMEs to get investor ready. Beyond that, to mention about NSE in a bit more detail also is that we are a full member of various relevant capital market forums. For example, we are a full member of the World Federation of Exchanges, WFE, which is, as the name suggests, a federation of exchanges across the world, both big and small. So that gives us a good platform to, of course, learn from others, but also showcase the NSE to the global exchange community. Beyond that, the other element probably to mention is we host what's called ASEA, the Africa Securities Exchange Association. Here, the NSE, and ASEA, as the name suggests, is an association of all exchanges across Africa. So in that sense, NSE is quite pivotal in not just forming, but also hosting the ASEA Secretariat. And in that sense, enabling us to drive a Pan-African conversation as far as capital markets is concerned. And of course, we have membership across many other relevant forums. On our listed securities side, we provide exposure to very many sectors of the economy, ranging from banks, insurance, manufacturing companies, construction companies, energy, manufacturing, telecoms, of course, which is one of our biggest. So essentially, the companies that are listed on the NSE are not just blue chips of our economy, but also even SMEs. And a lot of those entities are not just doing business in Kenya. They are doing business across, at a minimum, across East Africa, if not the larger region. So essentially, the NSE enables you to get access to opportunity as far as East Africa is concerned. The last thing I think to mention is, of course, given that we are a public listed company, we have requirements to have certain governance. So as an example, we have an independent chairman. Our current chairman is Nokiton, a very seasoned and accomplished business person in his own right. And then we have 4 independent directors and 4 non-independent directors. And of course, the executive director would be myself, the CEO. Of those 8 directors, excluding myself and the chairman, we have 2 representing listed companies and 2 representing trading participants, the likes of stockbrokers and investment banks. In summary, this is an exchange that has been in business for over 70 years. It is an exchange that is listed on its own exchange, so it has to adhere with all the conditions and compliance requirements and governance requirements required of listed companies. Number 2, it has regulatory powers. And number 3, it operates the only principal market infrastructure from an exchange perspective in our country. But also it is one of the largest exchanges in Africa. For example, on our equity side, we trade, our market capitalization is about another 5 trillion shillings. And on the equity side is 2.6 trillion. On the bond side is 5 trillion. Basically, our market capitalization of just more than 15 billion. We trade, depending on the day, we trade between $10 million and $50 million a day. And as I said, we rank quite highly compared to a lot of other exchanges in Africa. In fact, last year, Morgan Stanley ranked as the best performing exchange in Africa. And this year, I think we are on track to probably surpass that, depending on how the year ends. We can talk a lot more on market performance, but that's who the NSE is. Just to be clear, we are not a government entity, which a lot of people sometimes confuse us with. We are primarily a public listed company owned by foreign and local investors, and government only owns 3.36%. But we have regulatory powers delegated by government to us through CMA. And of course, we also interface quite a bit with central bank, given the treasury bonds that are listed and traded on our exchange. There is quite a lot of other things I can say about the NSE, but I think that gives a good flavor, Mokaya, to the listeners.
Indeed. On that note, it would be good to also say perhaps what your relationship is with the CASIB, with also CMA, with CDSC, and the roles each play towards making a functional market. That would be a good segue to that.
Absolutely. So our ecosystem, the capital markets ecosystem, has different stakeholders. Let me start with the regulator, the primary regulator who licenses and regulates every player in our capital markets is the Capital Markets Authority, CMA. And CMA rolls up to National Treasury. And I should also mention that CBK is also a key stakeholder in the ecosystem, given two things. One, the capital markets has a line to CBK via the treasury bond side of things, but also through the payments infrastructure that is overseen in this country by central bank, given how the huge volumes of payments that go through our infrastructure for purposes of settlement and clearing of transactions happening on the exchange. So that's CMA as a primary regulator and CBK. We also, of course, interact quite a bit with National Treasury to the extent that that's primarily the ministry that is very aligned to capital markets in Kenya. Then we have the depository, that's the Central Depository and Settlement Corporation, CDSC, which is, again, a key player on matters depository and settlement. NSE is a major shareholder of CDSC, but there are other shareholders in CDSC. But CDSC is everything happening on our equity side is the post-trade happens at CDSC in terms of deposit and settlement, and everything happening on our treasury bonds goes through CBK, and the CBK also has the depository for treasury bonds that are traded on the NSE. Then we have CASIB. CASIB is the Kenya Association of Stockbrokers and Investment Banks. These are licensees of CMA, and as I said earlier, we also have regulatory powers as first line, depending on how we're interacting with them on our market, as particularly brokers. And stockbrokers essentially enable investors to trade in our market. So onboarding you, taking your orders, or enabling you to send orders to our market, as well as in many ways providing research and advice to investors. That's the investment stockbroker side. On the investment banking side, they have a lot of activities, but primarily they will be originating transactions and bringing them to markets, either doing transaction advisory work, other corporate finance type deals. If you're a company that wants to issue a commercial paper, or let's say a corporate bond, or a green bond, or an infrastructure bond, they would go to investment banks for purpose of getting that transaction structured and put together, submitting it to a CMA and NSE for approval, and approval by any other required regulator, and then, of course, managing that transaction until it comes to market, and sometimes even supporting post-market. So that's CASIB. Then we have FMA, the Fund Managers Association. As the name suggests, this is an association for fund managers who are big investors on the NSE. You can, for example, think about any entity that is managing a fund that is maybe even a pension fund. They would be members of the FMA. And these are guys essentially who are allocating capital, but they're not the capital owners. They are managing capital and allocating on behalf of the owners of capital in that sense. Again, a very important constituent in our ecosystem. You cannot talk about fund managers without talking about RBA, the Retirement Benefits Authority. Again, a key stakeholder in the capital markets ecosystem, to the extent that they regulate the pensions industry and other constituents who are under their ambit. And as I said, pension funds, etc., are big investors on our exchange. We also have the Kenya Bankers Association. You would be aware that a lot of banks in Kenya actually operate stock brokerages under their umbrella. They also are a big source of transactions coming to our market, and also indirectly channeling opportunities to the exchange. And so KBAR is a big stakeholder as well. And then the other one I think worth mentioning is APTAC. In Kenya, we have something called APTAC, that's Association of Pension Fund Trustees in Kenya. APTAC essentially enables local institutional capital to float, for example, to our exchange, but note that there is, of course, some overlap with FMA. Then maybe also to close out is the likes of EASEA and ASEA. EASEA is the East Africa Securities Exchange Association, and ASEA, I mentioned before, is the Association of Stock Exchanges in Africa. So these are some of the key stakeholders on our exchange. Recently, we've also boarded UFA, that's the Unclaimed Financial Assets Authority, who are also a big player to the extent that they are sitting on portfolios that are part of the portfolios at the NSE. I could go on and on many others. Those are some of the core ones.
I just wanted maybe to break down a bit on investing at the NSE generally. Someone has asked a question on how people participate in the market. You could also speak to the role of the retail investor and institutional investor in investing at the NSE and how they can go perhaps through the brokers and be able to participate in trading. You can speak about that, and then the next would be about performance at the NSE so far.
Sure. So I will talk about the process, but I will also spotlight retail investors in particular because they are a core component of our new strategy at the NSE. Any investor wanting to invest at the NSE typically would have to open an account, essentially through their broker. The broker will facilitate opening an account at the CDSE. And if you're looking to trade equities, that's really more or less it. If you're looking to trade treasury bonds, as an example, ideally you can go through your broker, but ideally you'll open an account through DAO CDSE and then identify a broker to the extent that if you later want to trade that instrument, the transaction typically would come to our exchange through whichever broker you want, unless, of course, you want to go directly to CBK and do what's called rediscounting. But the key point to make is that you need to open an account through your broker. And the essence of opening that account, of course, is that there's a process to do KYC, know your customer, and other identity and anti-money laundering checks. And then on that basis, then, of course, you would go ahead and fund your account. And at that point, two things will either happen. One, you know what you want to buy. Let's just assume it's the first time you're coming to market. You know what you want to buy, in which case you can either instruct your broker, or if it's digitally enabled, you can put in your order. So essentially, let's say I want to buy 100 shares of NSE, 200 shares of KCB, 100 shares of equity, ETC, Safaricom. Then you put in that order, either directly through the stockbroker provided app, or you can instruct the broker to execute the order on your behalf. And the reverse happens if you want to sell. You could also, of course, give your broker discretion to trade on your behalf. That's up to you as the client to either delegate your trading responsibilities or decisions to the broker you've onboarded with, or as I said, you give the orders yourself. So it's that leeway. And typically from there, what one would expect most investors to do is to track the market. How is the market doing? How are the companies doing? What sort of information is being made available to you in terms of, for example, dividend declarations or rights issues or investor briefings on how their businesses are doing, half-year results, etc. And that will then inform your buy, hold, or sell decision. What I should mention specifically for retail investors is that up until 3 weeks ago, you could only buy a minimum of 100 shares of any given listed company. So if you wanted to buy, as I said, NSE or let's say Safaricom or Kenya Power or Kengen, you would have to buy minimum 100 shares of that company, which, as you can imagine, locked out quite a lot of people who either because of the nature of their budget or what they really wanted to do was buy maybe less than 100. That became a problem. So 3 weeks ago, we changed that with approval from CMA. So today as we speak, you can buy a single share. You don't have to buy the minimum. So that has opened up opportunity and access to our market to everybody, because now it means with 10 shillings, you can still participate in our market. Number two, we've seen a lot more interest now by retail investors. And I think these are some of the transformations that we want to drive in our market so that truly this is a market that is available to everybody. I should also mention that we have a fair split between foreign investors and local investors. We are more or less 50-50 now. In the past, it's been primarily foreign investors. We also have a decent split between institutional investors and retail investors. However, and our new strategy for 2025-2029, we have a huge ambition to mobilize retail investors to get back into our market. We have, for example, close to 2 million retail accounts that are dormant, either because they came to the market during the Safaricom IPO and they've gone quiet, or they don't get enough support to understand the market so that they are able to stop being dormant and trade. In our new strategy for 2025-2029, our ambition is to have 9 million active retail investors, active being the keyword there. And retail in our case is both local and diaspora. In many ways, it's very ambitious, but in some forums, we've been told that's not ambitious enough. But for now, we are focusing on getting the 9 million by 2029, 9 million active retail investors. Part of that requires us to change our systems, upgrade our systems. It requires us to run more robust investor awareness and financial literacy programs. It requires us to make it easier for retail investors to get into our market and trade. And of course, it also requires us to work very closely with other stakeholders to make that a reality. I can guarantee you that without having very sizable and active retail investors, it's almost impossible to have a vibrant exchange. And when we were formulating our new strategy, we took time to understand what other exchanges have done. Those that have done well, what has happened? Those that haven't done well, what's the issue? And what was becoming consistent is you have to have very active retail investors, and you also have to have very active local investors so that you're not overly dependent on foreign investors. To close that point on retail is that it's not just about onboarding and bringing investors into our market. It's also making sure that we have the right products for them to trade beyond the listed equities, beyond the derivatives, beyond the bonds. What else is available? For example, we are pushing to have more ETFs, exchange traded funds. In fact, you will be surprised to know that in major, larger foreign exchanges, case in point, NYSE, New York Stock Exchange, NASDAQ, the likes of India as well, structured products like ETFs outnumber listed companies. So we know that we need to introduce more of these sort of products so that retail investors, as we onboard them, find that variety. They are able to trade as frequently as they would wish, but more importantly, they have that diversity of products that are fit for purpose and are available for them to trade. I should finish that point by saying there's no doubt that the liquidity that is sitting within the retail space is huge. I will give an example of the success that government through central bank has found by implementing DAO CSD and the sort of the huge volumes that are flowed from retail investors to government paper. Similarly, if you look at, for example, the amount of money that is sitting in money market funds, primarily retail, SACCOs, that's primarily retail investors. You can even mention things like real estate, chamas, the remittances that are coming for diaspora. Kenya receives around $400 million per month from diaspora. Now, diaspora, and I was one of those, and I know Okoya, you are one of them as well. These are individuals, these are retail, you and I, among others. So our plan is to enable retail investors to participate in the NSE. Once we do that, and we do that successfully, there's no doubt that institutional capital will also flow. Interestingly, as we've started getting that going, last month, institutional investors overtook retail investors. So you can see retail investors start coming back, and then they attract institutional investors. You then have more liquidity so that the market gets more liquid, which means you can come and go from the market with a lot more ease. You don't have to wait for so long for your order to be filled or indeed for your transaction to happen. So Mokaya, the point I was making is it's easy actually to open an account to the extent that you work with your brokers, etc. But having opened an account, we must make sure that there is opportunity for you to harness on our exchange.
You've preempted my discussion around the investor participation and the fact that the local investors have overtaken foreign investors in participating in our local market. That's really brilliant to see. Maybe tell people a bit about how the exchange has performed in 2025. That's been a bit of a highlight. And I think a bull market is always a time when more investors get attracted to the market a bit more. Because I think back in 2007, there was a day, I think East African cables was almost doubling every day. And I think that was my past point of interest in the market. So I would say such points in markets are times when retail investors get attracted a bit more. So tell us a bit about the performance of the NSE itself as a stock and then also as an exchange this year and how that compares across other African markets.
Because we are a public listed company, it means that we can only discuss the performance that has been published for the half year. So that's what I will focus on. But before I do that, let me first highlight that 2024, last year, the full year was a phenomenal year for us. I mentioned earlier we were rated the top performing exchange in Africa by Morgan Stanley. But also, our bottom line was really good. We reported an uptick in our profit after tax of 550%. So we closed the year last year on a very good note. Now, the first 6 months of this year have equally been good. And maybe I should start first by saying that given how NSE makes money, its business model, I think it's important to first underscore how our primary products have done, and then easier for the listeners to tie that to the NSE's own performance as a company. You recall I mentioned that we are a food service exchange, but on the trading side of it, which is 60% of our business in terms of revenues, is primarily the trading of equities and the trading of bonds. The equity market for the 6 months, the turnover increased by 88% to sit at 56 billion shillings, up from 47 billion recorded over the similar period in 2024 because of the bull run you've mentioned, Mukaya, as well as the support from some of the reforms we are making and the strategies we are implementing. The bond turnover rose by 78% to settle at 1.3 billion shillings, up from 71 billion that was recorded over a similar period last year. In fact, that's an important mark to underscore because it marked the first time that bond turnover crossed the 1 trillion mark over a 6-month period. And we think that that trajectory will sustain. Similarly, our various key indices have also been up significantly over the 6-month period. For example, the NSE All Share Index, which tracks the entire listed equities, was 24.25% in the 6-month period. And so did all the other indices. NSE 20 was up 21.3%, NSE 25 was up 16.74%, and NSE 10 was up 16.48%. And the bond index itself was up 4.7%. So all our market indices, as well as the capitalizations and the turnovers on the equities and the bonds, rose very positively. And I should also, probably before I talk about our financials, also mention that foreign investors have also been very active in our market now. We saw the total turnover for the first 6 months, about 60% of it was foreign investors and 40% was domestic. So we see foreign investors back in the market. And of course, to the extent that they are primarily institutional investors, it brings quite a lot of capital onto our exchange. I should also highlight that we are also seeing an increase in our PE ratios. For June 2025, the PE ratio was sitting at 6.54, which tracks quite well, but not good enough if you compare it, for example, to our highest period, which was 2017, where the PE ratio was sitting at around 32. And so having highlighted those aspects that speak to the market performance, now let me speak about our financial performance. Again, I said I will stick to the June numbers because those are the numbers that have been approved and communicated. We cannot talk about the other numbers until they are reviewed, given that we are a listed company and have to adhere to regulatory requirements. Our total income for the first half year of 2025 was up 119% to settle at about 172 million. Our profit after tax, again for the 6 months period, was up 177% to sit at 151 million. And our total assets also grew by 7% to sit at 2.29 billion. Related to that, our total expenses dropped by 9% to sit at 309 million compared to half year last year, which was about 339 million. From an highlight perspective, what that speaks to is, given that the market the other metrics I talked about were all up. It's no surprise that our own financials also were up. But also, we've been managing our costs down. In our new strategy, our ambition is to have a cost-to-income ratio of 40% by 2029. Right now, it's hovering in the upper 70s. And since we sit within the larger financial services sector, ideally, our cost-to-income ratio should be aligned with the industry average, which is around the 30 to 40%. So we have some work to do to bring our costs down. And the primary cost is tech. This year, we are upgrading our market infrastructure to modernize it, to make it more open so that other players can interact with our system much easier, integrate the newer technologies, for example, around leveraging AI and more advanced data analytics, etc. So we should be seeing our tech cost start to drop from next year, especially given that we are switching from a CapEx heavy model to an OpEx model, primarily through opting to go into a software as a service tech model. So that should also help bring down the cost to income ratio to the target that we have for 40%. Other financial highlights I think that are worth highlighting is our return on assets. Our return on assets is up 10.3%. It's now at 13.2 as of end of June. Our return on equity is also up. It's sitting at 14.8%, so it's up 11% from last year. And our earnings per share is also up 176%, moving from 0.21 to 0.5. And if I finalize that from an income perspective, I already mentioned the equity transactions levy. That's primarily our top line, the levy we charge for transactions happening on our market. So that's the equity transaction levy. We made the 133.8 million out of that, so 18% up from last year. Our bond transaction levy is also up 78% from last year, still sitting at 153 million. And other income also went up by 78%. Other income are things like our data business, which is doing very well. It's on a very nice trajectory, and we see that as a huge growth area for the exchange. There are exchanges in the world where the income they make from the data business is multiples larger than the other revenue lines combined from, for example, equity levies, bond levies, etc. And the more your data business grows as an exchange, the more you know that people out there are interested in understanding your market and, of course, trading it. So if you find you're running an exchange business like ours and your data business is flatlining or it's non-existent, in all likelihood, that's already a data point to tell you your exchange is as good as dead. With the advent of AI, we think there will be even bigger opportunities around data to enable, for example, retail investors to access our data at reasonable rates and interact with it. If anything, what we are seeing in that space is entities, not just exchanges, but even other entities, the curve is to move from just selling data to selling insights. And you can imagine the only way you're going to sell insights, which is a more value-added proposition, it requires you to really invest in different type of skills. So for example, you need to, of course, harness the power of AI. You need to harness very good skills around analytics and data science, and of course, distribution infrastructure. But that's a big growth area for us. And for the listeners that have interest around data, we are open to have a discussion and see how we can collaborate. So that marks the highlights on our financials. You can hear the better than last year. We think we'll finish this year on an even higher note. And of course, as we implement our new strategy, there will be opportunity to also optimize all that.
Many questions have come in. I want to maybe highlight for you a few. On the data aspect, one of the issues that you had is the data is pretty expensive sometimes to access. Is there something you're doing in that regard to reduce the costs there? So secondly, we've also been asking for the earnings calendar and at least earnings calls from some of the companies that are listed. What are some of the progress that you've made there? And then the third thing, if you could update us a bit on the impact that the move from the 100 shares minimum trading to one single share and the impact maybe it's had on the market. It's been a month now of implementation. Your quick thoughts on those 3 points, and then I have a couple more questions.
Let me start with the data. Yes, we have received that sort of feedback on the need for us to look at the cost of data and see how we can optimize that. We've taken that feedback. We are working on it in three aspects. The first aspect is to see whether there are different data packages we can offer that then have different price points and make it easier. Number two is to relook at our infrastructure, because a lot of times the cost of data is also a reflection of the underlying infrastructure that is used to curate and serve that data. Some of the changes that we are looking to do around our market infrastructure will help smoothen that, and the end result would be better pricing. That bit is also to see how specifically for retail investors we can curate maybe a different proposition for them. For example, instead of just enabling you to access data, perhaps we talk about, let's give you alerts. We will crunch the data ourselves and give you alerts that you can then decide whether to act on. I think that probably is the breadth of some of the changes that we are looking to do. And yes, the feedback is well received and we are acting on it. It is actually in our interest for more people to have access to our data, because as I said, that then catalyzes trading. It also catalyzes ideas for the various players to also bring more innovation to our market. So keep the feedback coming, keep us honest. But as you hear, the intention is to really make it work, especially for retail investors. That's on the data, and you will need to bear with us as we are getting that done. On earnings, I think if I got you right, it's, for example, corporate actions, earnings, investor briefings, things like this. Before I answer that, let me clarify some of the gaps we have in our market based on our observations last year and why that's related to this point about corporate actions. In reality, all listed companies should have very well-established and active investor relation teams, departments and teams, because it is those investor relations teams that wake up every day to make sure that they are pushing out data and insights to their investor community so that then they can act. For example, it should be the case that a listed company through the investor relations team knows that if there are any AGMs, if there are any dividends, if there are any rights issues, if there are any maybe regulatory issues that shareholders need to know or investors, those need to be pushed out through various mechanisms in social media, newspapers, emails, etc. Now, here's the gap. A lot of listed companies, unfortunately, either have minimal investor relations capacity or none at all. As a result, what we found last year is that if we don't work closely with CMA to correct that, then it becomes extremely difficult to address what I would say are basement issues, ground floor issues like giving investors information on earnings calendar or even holding investor briefings. So last year, in collaboration with Capital Markets Authority, we reached out to listed companies and worked with them to really make sure that they understand why these sort of requirements around earning calls, investor briefings, corporate actions, etc. are very important. And also for them to provide that information to us and Capital Markets Authority so that then we can push that out to the market. So we did that last year. We are continuing to monitor that. I would agree that there are some gaps in terms of either information not being made available at all or not being made available on time. But I am seeing improvements happening. The expectation is that ideally by the end of this year, this is not a point we should be discussing anymore for listed companies, because it is also of value to them that they provide this information to yourself. Through our regulatory affairs team here at the NSE, they are working with the listed companies and the compliance officers in their organizations as well as their investment relations teams to make that happen. And so you should be seeing that getting corrected over time. And to the extent that's not corrected, of course, you can always reach out to us so that we can enable that to be corrected. And by the way, that has also been feedback given to us when we go on investor roadshows. For example, our chairman, myself, and a couple of other colleagues were in London sometime last year, meeting large global players, BlackRock, Ashmore, and people like that. And it was almost a consistent feedback across those entities that they really need more investor briefings, more proper corporate actions reporting, so that they are able to use that information to also trade our market. So you're right for this audience to raise that issue. And you can be sure that our sales and CME are working very closely with listed companies to really make that happen. It is what should happen naturally, especially when you're dealing with an exchange as important as ours for the African continent.
I agree with you on that, especially because an informed public is also able to make informed investment. It's something we've been pushing for here, and we thank you and the NSE for taking that initiative to actually push for the earnings calendar and earnings calls.
Absolutely, and there's still work to do to get that done properly, but I agree with you. An informed public will make better decisions and, more importantly, act in our market. On the one share, so yes, you're right, it's a month now since we introduced this new rule. We have seen two things. One, we have seen more retail investors trading our market. By that I mean they were already in our market but not as active. Now we're seeing that ticking up. We have also started seeing new retail accounts being opened. We still have some work to do to absolutely publicize the implication of this new rule, the ability for investors to buy one share as a minimum. So the traction is there already, Mokaya. But yes, there's a lot more work to do to inform the market so that then everyone knows our market is available. I should say, in all honesty, we've also gotten feedback in the past, and it's been part of the input into how we formulated our new strategy, that our market has been considered for a long time to be elitist, or maybe available only to people with money, or sometimes seen as of one needs to be very technical to be able to trade our market. So as we are rolling out changes to enable our market to be more inclusive, including, for example, the one share, we also know that there is awareness we need to make. We need to demystify the NSE. We need to be able to take the NSE to the masses. And more importantly, we need to bring more products that support that push. Now, maybe to close, I should also say that one of the other things that CMA has approved is our request to enable fractional trading. So moving beyond just one share, being able to buy a fraction of a share. And what that actually means is that, say, for example, I have 100 shillings. Instead of buying, let's say, one counter, I can take that 100 shillings and buy fractions, if not one share, fractions of the entire NSE 63 plus shares that are listed on our exchange. So you will be seeing that coming through. It's already been approved and it's in pilot stage with one of the licensees, Sterling Capital. And so in good time, I think you will also see that helping bring momentum behind the one share. And the expectation then would be that even when we talk about data, the previous question you asked, Mukaya, we can now also see how to slice our data offerings to support the retail sector in a more robust way.
I like those suggestions that you're making. I should say there is an audience member who's specifically saying, thank you so much for launching the single share trading. It has helped all shares that were only a dream to me. I guess that includes shares like Stanchart, which trade at 300 shillings plus. That's a good initiative, I would say. And fractional trading is most welcome. Before I take you to a few audience questions, I wanted to also give you a chance to also respond to some of the concerns which have been there. Lower commissions, that's one of the issues that we're trying to raise, that it would be good if you can lower commissions so that you can be able to enable more retail investors to come in. And then also the issue of IPOs and new listings that can also excite the market. I know Kenya Pipeline, there's few issues about legal issues there, maybe a court case, but it's one of the listings that was supposed to excite the market in the months or weeks ahead. So perhaps you can speak to new listings and lower commissions as some strategic initiatives that you want to make, at least to excite the retail investors.
Sure. Let me start on the listing side, then I finish with the costs component. In our new strategy, we have 9 ambitions, but 2 of them speak to listings. And number 1 is to have 40 new listings by 2029. That's company listings. And then to also have 50 listings of listed and structured products. On the company listing side, I think you'll be aware that earlier this year, we listed the SKL, which is a packaging manufacturing company. And that really broke the listing drought that's been there. What that means is that in our strategy, we are 1 down, 39 to go as far as the 40 new listings go. And before I talk about what's in the pipeline, we've also listed two instruments this year. We listed, as I said earlier, the Citrix ETF, World Feeder ETF, which is an exchange-traded fund that enables investors to get exposure to over 3,298 listed entities across 23 developed economies in US, UK, Europe, and Japan through a single transaction. So we listed the ETF earlier this year. We also listed an asset-backed security, Talanta ABS, that was a product that was structured to enable the funding of the sports infrastructure in Kenya. That was about 44 point something billion shillings. So again, on the 50 listed as structured products, we are 2 down, 48 to go by 2029. And then now we talk about what's in the pipeline. And the question is absolutely spot on to the extent that an exchange, by and large, should really be having IPOs every so often, because that variety is what is required for investors to continue to be active on our exchange. Now, let me talk about the pipeline. Traditionally, NSE and a lot of exchanges in Africa have relied on privatizations of state-owned enterprises as the major source of new listings. Now, that has its own pros and cons, but in Kenya, and definitely for the NSE, privatizations continue to be a key source of listings either way. Why? Because there's over 300, I believe, I think the last number is probably 298, but I think it's around 300 now, entities, state-owned enterprises that potentially could be privatized, and that privatization could mean, for example, doing an IPO through the NSE. And in Kenya today, we have Kenya Pipeline as one of the entities that has been identified for privatization. You will have seen in the press that the process of seeking approval has already begun. 2 weeks ago, we made a presentation to the National Assembly, the Parliament, on our position as far as why KBC should be privatized, and more importantly, why now. From a timing perspective, the cabinet session paper to support the proposed privatization of KPC points to the government wanting to raise about 100 billion shillings by selling 65% of KPC, Kenya Pipeline, and retaining 35%. That would be a big IPO in our market. From our calculation, initial assessment, when it comes through, it would be definitely bigger than the Safaricom IPO. We think it will be highly oversubscribed, given that we've had a lot of sort of soft market sounding even from foreign investors that are very keen to invest. And I should also say KPC is a very profitable business. Last year, it gave 3 billion shillings as dividend to the government as the main shareholder. But that also tells you that there is a lot of opportunity to optimize Kenya Power to be an even bigger and more successful organization, similar to what happened with companies that have been privatized in the past: Safaricom, Kengen, KCB, Kenya Power, among others, that are not only were privatized, but went on to become super successful, and actually to go beyond Kenya and help build the larger region. So that's our view on Kenya Pipeline, and National Treasury and other stakeholders are working very hard to make that reality. Ideally, we would expect that despite some of the challenges around court cases, that Kenya Pipeline will be privatized and IPO'd this year, if not maybe Q1 next year. But from how it's looking, we think this year. There are other companies, other state-owned enterprises that are also on the list for potential privatizations, including the likes of New KCC, potentially Kenya Ports, and others. But the process has to be followed in terms of should they be privatized, how should they be privatized, and of course getting the very relevant approvals, including approvals from Parliament. So that's on the privatization side. But there are other areas we are looking for IPOs from a pipeline perspective. So let me mention them, but in summary. The first one, where we think there is a huge potential, is enabling private equity to exit their portfolios companies through the NSE. In fact, this morning at about 7 in the morning, we had a meeting with the board of the East Africa Private Equity and Venture Capital Association, and that meeting was chaired by the Cabinet Secretary for National Treasury, C.S. Bandy, and in attendance also other stakeholders. But that conversation was about what policy support is required to enable private equity and PE firms and DFIs to exit their portfolios through the NSE, because they are struggling to exit simply because the preference has always been for them to maybe do secondary trade sales or set up a secondary fund and exit to that. But NSE now wants to be an option and an avenue for them to exit their portfolios. And these are entities that have invested in very good companies. Think Good Life, think Java, think I&M Bank, which Africa Invest is a big stakeholder, among others. So that would be one of the areas where we would be seeking pipeline for IPO. The second area we are looking at is family-owned businesses, which if you do your research, you'll find they are a big stakeholder in businesses in our economy. Some of the most successful and very well-governed businesses or companies in our market are family-owned businesses. So the intention is to sit with these family business owners and also get, first of all, a pretty good understanding of the reason they are not looking at NSE as one of the ways for them to secure their legacy by listing their companies, but also to take feedback. And we've had several workshops so far with a number of them to take feedback on the sort of issues that they have. For example, they've raised issues around losing control. They've raised issues around if you become listed, you need to have independent board members, and the family members may have to be kicked out of the board. What does that mean? So you can imagine that if we have to make it work, because they are keen on coming to the NSE, but not necessarily under the current framework, then it means we need to sit down and curate a listing program that is specifically tailored to the family business segment. The last one, Mukaya, is the single biggest engine in our economy, SMEs. And when we were formulating our new strategy, we were quite clear. You cannot say you are a relevant exchange in an economy like ours if you cannot service 90% of the entities that the economy runs on, which is SMEs. And as much as we've made changes last year to make it easier for SMEs to list in our market, there is still a lot of work to do to really enable SMEs to be investor ready, to be listing ready, and to be able to remain compliant post-listing. So what we are finding is that we need to really prepare them, panobit them, for lack of a better choice of word, but also accommodate some of the peculiarities that SMEs are. But I'm entirely convinced if you are in financial services, whether you are in an exchange or whether you are a bank, as an example, or an insurance for that matter, if you're not offering sensible solutions to SMEs, I think your relevance, one can score it very low. And we know the SME sector finds it very difficult to access capital. Yet other markets have been able to formulate ways to support them. India is a very good example. So we want to really be responsive to the SMEs, and you will see more work being done around that to enable us to really build that pipeline to come through in our market. Interestingly, a lot of you are already investors in SMEs. So we know that from an investment perspective, people are happy to make an informed decision and take risk to the extent that that's what it is. But the success at the NSE of getting that huge segment access capital through us has been patchy, and we want to really respond to that. Lastly, to close the point on pipeline, is startups, which are very different and unique compared to SMEs. So for startups, we've started engaging with some of the platforms like incubators and accelerators and venture studios and some of the other associations, for example, the FinTech Association, etc., to try and start understanding the startup scene. And then in that way, we can figure out what sort of opportunity we can provide as far as enabling startups to come to our market and raise capital through the NSE, and of course give that opportunity to both local investors as well as foreign investors, as opposed to these startups having to jump on a plane and go to, I don't know, California or some other places to seek for funding in other markets. We are strategically looking to bring that pipeline through, both, as I said, public sector through privatizations, as well as the private sector through the various elements I've touched on.
And then the commission bits, and some listeners also want to know a bit about what's happening with CASIB and NSE.
Yes. So before I talk about CASIB and cost, I was going to close the point about listing by saying the other element we are looking at is cross listings. So to bring more cross listings from other markets into our exchange. For example, in Nigeria, if you got, let's say, Dangote cross listed to our market, or our, let's say, banks in Tanzania cross listed to our market, then it would also improve opportunity from a listings perspective. Let me move to cost. So this point about cost has been raised severally, and we know it's a hot topic. And the irony of where we are is that when institutional investors interface with, for example, brokers or other players, because of the nature of their ticket sizes, they tend to be able to try and get, let's say, discount costs on the trading cost compared to retail investors who typically probably don't have that bargaining power. But costs have different components. Remember, the commissions you pay, the majority of the commission goes to brokers. And then there is a fee that is split between NSE for the market infrastructure and CME as their regulator. What that means is that in order for us to move the needle as far as cost is concerned, all these stakeholders have to align. And from that alignment, it's much easier to come to the market with maybe a different proposition to the current one. What we are seeing is that in order to have a conversation about costs, we need to also tackle three things. One, we need to tackle the biggest contributor to cost, which is tech. For example, our push to modernize our market infrastructure, which also would mean that brokers also have to use that as an opportunity to also modernize their own infrastructure on their side, including the broker back office that connects our market to the broker side. That could be one of the ways that we then reduce the overall cost base, and which means then that there is potential there to negotiate the costs down. The second bit is that we need to have a more active, bigger, liquid market so that the volumes compensate any drop in costs. And then the third thing is how people access our market. Back in 2019, the CMA approved the NSE direct market access guidelines. And the guidelines speak to using technology to reduce friction between the investor and our market. What that means is, for example, a transaction, when the NSE DMA guidelines are implemented, what that would mean is that when an investor puts in an order, it goes through the broker's infrastructure to come to the NSE, but the broker does not touch the order. Essentially, it is sponsored access. So you're not coming to the market without going through a broker, but the effort by the broker in terms of touching the order or processing the order, all that process is automated. What that would mean is that brokers would then be able to spend more of their time and effort doing more value-add activities, for example, providing more advisory support, providing more market research, etc. Now, when that happens, it is much easier then for brokers to sit and say, perhaps, first of all, we would expect the volumes would go up, and that would then be a good business case for brokers to potentially consider reducing costs. So you will have seen that we are keen for the approved guidelines to be implemented. For example, has already started doing that. They onboarded their counterpart in South Africa, ABSA South Africa, with the CMA approval and our approval. So South Africa can trade our market directly. It's coming through, of course, ABSA Kenya as the broker, but without that sort of intervention. But you can hear that is more of an institutional play. What we want to do is replicate that for retail investors. In order to do that, we need to first upgrade our market infrastructure and, of course, make sure that the support is there, especially to the brokerage community, for them to be able to also do the transformation that's required from a tech perspective on their end. We have several other brokers that have already started open discussions with us to start enabling direct market access. So we should be seeing more of that. Which, before I turn to the CASIB issue, is to say the way most developed markets have gone, this is actually the route. Why? Most retail investors trade on mobile phones. A big chunk of retail investors, if you are a broker, as an example, and you provide them with a good trading interface, mobile-enabled trading interface, you include market data as one of the ways for them to understand the market, You support it with financial literacy and investor education programs. You support it with market research. You also have a very streamlined KYC self-onboarding process so that I can open an account and start trading within, let's say, 5 minutes. I wanting to do now. That process does require embracing tech in a very serious way. The beauty in Kenya is that you have a high penetration of mobile phones, smart mobile phones for that matter, very good data coverage. People are fairly well educated. What we now need to do is go to the next level, which is enable very swift onboarding, just like banks have been able to do. We should also leverage, for example, the Safaricom M-Pesa infrastructure as one of the ways for people to self-onboard. I should not have to meet with anyone, and I should not have to move hard copies of documents left, right, and center to be able to open an account and start trading. So you can see there is a lot of work that needs to be done to make those sort of transformation and reform some of the processes we have, so that we move our market to the current century, if I were to put it that way. And then you can be sure the market where we are now, as much as we are saying the market is doing very well, in my view, we have not even scratched the surface. And the best way to explain that is to say, look at what has happened with the betting and gambling sector. They have been able to harness mobile phones, self-onboarding, social media, etc., to actually enable hundreds of thousands of people to instantaneously open accounts, instantaneously fund them, instantaneously start trading them. That's the way forward, and that's what's happening in other markets. And as much as it's going to be a walk in the park, it is literally what has to happen for this market to get to the level it should be, especially for an exchange that as important as NSE for our country. The conversations we were having with CASIB related to feedback they had on some of the interests they have on the NSE. For example, market intermediaries have tall board seats that are reserved for them. One of the directors retired last year. That was the former vice chairman. He was called Paul Mwai. He retired last year. And so we needed to replace that. That process has to go through a process because we are a public listed company. There's a documented process. So now directors get onboarded to the NSE, including approval by CMA. The back and forth was on us making sure that process is followed as opposed to skipping any step in that process. And that was managed and resolved. So we don't have an issue there. And to the extent that the CMA approves the potential candidate, then that candidate will be onboarded. Otherwise, the internal processes were followed. He was okay with that. The other issue that was raised was with regard to what I've just described, which was direct market access. Some of the market participants misunderstood what DMA means. They thought DMA means they have no role to play. Clearly communicating the approved guidelines dating back to 2019. I think what happened was the guidelines were approved by CMA, but they were not communicated to stakeholders. As a result, I think a number of them were flying in the dark. So we've had to reclarify what that means. And there's also a lot of awareness and education that needs to happen beyond the broker community so that people understand what DMA means and how it will be actually made to happen and why it must happen if this market has to change. Again, that's a point that has now been put to bed. What's required is just continuing to share information. And then the last point related to our strategy, what had been raised was that they felt that we needed to engage with them more on what our new strategy looks like, despite the fact that we thought we had done that last year in the course of formulating our new strategy. Again, that matter has been put to rest by resharing our strategy, as well as holding a few more sessions with them for them to understand our new strategy and for them to ask questions. Not a single comma or full stop has been changed in our strategy, as our strategy is approved by the board, who are the only organ that can actually change that. However, of course, it's not just CASIB, it's all the other stakeholders, including investors like yourselves, who must understand our strategy, give us feedback, of course, and then we use that as the basis to improve it. But for changes to happen, that, of course, also has to go through board approval. The responsibility of implementing strategy in any given company rests with management. Shareholders will sit and keep us accountable through the board on how the strategy is implemented. But the primary, if not the only, responsibility for strategy implementation sits with management. Having said that, though, it's important to work with other stakeholders, including, for example, earlier you had me talking about CBK, talking about National Treasury, talking about Fund Managers Association, etc., because you've had me mention that the ambitions we have in our strategy require us to collaborate with several of these actors, including SACCOs, for example, who we are targeting as one of the ways to unlock retail investors. Now, the minute I say we need to collaborate with SACCOs, we need to work with SACCOs, automatically it means I have to work with SASRA, who are the primary regulators of SACCOs. It also means I have to work with Ministry of Cooperatives and SMEs, because that's the ministry that regulates, oversees that sector. So depending on our strategic choices, then we look at who are the stakeholders that we need to map and work with in order for the strategy to become successful. A market like ours that has been in place for over 70 years comes with a lot of historical issues that have made the NSE what it is now, but it is those same issues that we need to benefit from for purposes of going to the next level. So the CASIB issue is settled. These are key stakeholders. In fact, CASIB is a tenant in our own building, so we see each other every day. And we welcome all sorts of feedback that should always come our way as far as key stakeholders are concerned. But the point to emphasize is that transformation does not come organically. Transformation comes through people having a vision, formulating a strategy to achieve that vision, and then absolutely getting down to the trenches and starting to implement. We are already 8 months into implementation of our new strategy. You can already see the success that's having, but we have 4.5 years to still go in terms of the strategy period. Since we are not operating in a vacuum, it does mean that from time to time, there will always be feedback that comes to us that we need to deal with. But as far as the integrity of the market and more importantly, the direction of the market is concerned, a big portion of it will be informed by the NSE strategy, of course, by also other factors. For example, there is the CME's master plan for our capital markets in terms of how they also see the development of this sector. And we also have to align our strategy to that master plan, as do other stakeholders that are part and parcel of the capital markets ecosystem.
We've spent a bit of time discussing the strategy, the business itself, understanding a lot of the core concepts and the key things that need to happen. So I think one final question, and then we can conclude. One is on the companies that are not doing so well, but are still listed. That includes the likes of Mumias Sugar and what's supposed to happen to those kind of companies. ARM, I think, is still listed and all. So what you're doing in that regard. And then finally, now you can give us a bit of a vision on where you want to take the NSE in the next couple of years and some of the initiatives that you have in mind for that and what inspired you to join the NSE. I think we can close there.
You're right. There are companies that are listed on our exchange that definitely have issues. Mumias being a good example. You will also have seen recently Trans-Century and East African Cables were also put under receivership and the administration on the back of some financial distress that they had. What are we doing about it? So tail end of last year, we developed recommendations to set up a recovery board. The intention being that companies that don't meet certain requirements in our market be considered for recategorization to sit in the recovery board. And then if within a given period of time, they do not recover, we then can consider delisting. We start with the Capital Markets Authority to discuss that. They've given us feedback. We are reworking some of those recommendations, and then we will resubmit that to Capital Markets Authority for review and input. And then on the back of that, once it's approved, then we can start communicating that out to entities that are affected. And depending on how that goes, then either those entities recover, or if they don't recover, depending on what the final position is, then they may be delisted, or they will continue to sit in the recovery board until such time that other actions are taken. And we are doing that because, first of all, we've studied how other markets do it. Some markets are very harsh, where they go automatically to delisting. Other markets are middle ground, and more or less that's what we are aligning with. Why? Sometimes delisting a company can actually contribute to its total demise. So there is work to do first to understand why a company is in a distressed position, what actions are being done by management and shareholders to correct that. And having understood that, it is then you can make an informed decision as a first-line regulator as well as a stakeholder in the capital markets ecosystem on the best course of action that has the best outcome also for investors. And also don't forget that there's almost every entity that in that category typically ends to have its position is very unique. So you can't paint all of them with a single brush. Look at Kenya Airways, for example. Kenya Airways has government support. And beyond government support, it's actually taxpayers' money that have been put behind Kenya Airways to support it. You can also see management implementing certain turnaround strategies to reposition KQ back to normalcy. So you can see that some of these entities have their own uniqueness. So maybe the idea here is to, number one, have a structured way to deal with distressed entities. And also, investors need to realize that companies do get distressed, in which case, the situations like we are in can happen. The beauty is the majority of the entities that are listed on the NSE are not in that category. So I feel that the measures we are taking now with time will help make the situation better. And more importantly, also, perhaps there are lessons to be learned in that process that will inform how companies list and how companies also comply regularly with the various requirements once they have listed. That I think is help. But I should say, Mokaya, on that note, that the primary person to keep companies on the straight and narrow is actually shareholders. It is you guys who've invested in these companies who should attend the AGMs, who should ask questions at the AGM, who should suggest ideas to these entities that you invested in so that they can get better. It is investors, the shareholders, should first and foremost be attentive to the companies they invest in and be active in them. Then regulators, first-line regulators like ourselves, as well as other regulators like capital markets authorities and other regulators are supporting that process. So it's important that shareholders pay attention to companies investing and be active and responsive to them. So that's on entities that are distressed. What were the other 2 points? There was one about why I joined NSE and the vision I have for
Yes,
NSE.
now you can lay out the vision for the next couple of months and then you're closing.
Let me reverse it. Let me talk about what I considered in terms of making the decision to join the NSE as the CEO, and then we'll close with the vision. I mentioned in my introduction that I've spent the bulk of my time in financial services, primarily in investment banking out there, and then management consulting before investment banking and after investment banking. And I also ran my own corporate finance outfit. In many ways, my intention had been continue to remain in the financial services space, potentially transition to either fund management or private equity. However, when I was approached for this role and we had conversations with various stakeholders, the board, etc., I looked at 3 things. Number one is NSE as truly a very professional board. That's very important for a CEO, any CEO, that you have a very good professional board, because in the absence of that, it becomes extremely difficult to execute on anything, potentially even achieve much success. So that was my first consideration. The chairman and the directors of NSE, very professional, accomplished people in their own rights. That was the first consideration. The second consideration was that NSE also has very good standing definitely in our market, if not the entire of Africa, and very good relationships with, for example, the government of Kenya. Again, a very important consideration for an exchange, because in the event that you don't have that sort of profile as well as very solid relationships and support from government, for example, the relationship with CMA, relationship with CBK, National Treasury, and the like, as well as the office of the president, then it becomes extremely difficult to really have a solid role in capital markets and, more importantly, economic development of the country. So that was, for me, a key consideration. So I confirm it was the case then, and it is the case now, that we have the profile and the support as NSE in Kenya and beyond. And then the other last consideration was the existing strategy was coming to an end. So it means as CEO, I get to sit with the NSE team and the board to formulate a new strategy and execute on it under my watch. And it's an important point to underscore, because for those of you who are CEOs and those of you aspiring to be CEOs, executing somebody else's strategy is very tough. In fact, in all likelihood, it is a recipe for disaster. In many ways, that was a big consideration for me, because I get to come in and formulate strategy and implement it and be held accountable for it, for that matter, in collaboration, of course, with my colleagues at NSE. In fact, that was my first order of business when I joined in May last year. The first order of business was to figure out where we are and then get my head down and work with my team to come up with a new strategy, which is what I've just mentioned. And our new strategy for 2025-2029 was approved by November last year. And it has the various strategic pillars that we've published in there. So those were the three key considerations. Of course, I would be probably also remiss not to mention I'm 48 years old. So having spent 15 years outside Kenya and then come back home, my intention, of course, is to contribute and play a significant role in Kenya's economic development in order to be able to contribute to the growth of our country and our region and Africa at large with all the skills and experience that I've picked up along the way. And so I see this as a role that is instrumental in enabling me to work with my team to make that a reality. In fact, and our new strategy for NSE, our new purpose for NSE is to inspire Africa's transformation. So we are not just thinking about Kenya. Our vision is to push our impact beyond Kenya to the larger African continent. It's important that a country like ours has a very robust and successful exchange, because then businesses, entrepreneurs, project owners, government itself can access capital readily and in that way contribute to our national agenda as far as economic development is concerned. Ultimately, my vision, Okaya, is that NFE becomes, first of all, leading exchange in Africa. It should be the case that every Kenyan is aware of NSE and knows how to leverage NSE to invest, to raise capital, to prosper. And that vision requires, of course, interaction and collaboration with very many other stakeholders. And I think the trajectory we are on as we execute our new strategy 7 months into it now, I think those green shoots are already appearing. And it won't be long, I think, before we start seeing that vision becoming a reality, so that by the time I'm leaving here, we hand over to the guys behind us. They are building to even higher heights. And as I said, maybe in closing, we need sessions like this where we get questions and we get feedback, we get suggestions, so that then we can use that to do a better job of making NSE as successful as it should be. Lastly is to say, there is a lot of change that is happening around the world. Think about, for example, the pace of change in technology, the pace of change as far as rebalancing between the West and the East, what's happening there. Think about demographics, the changes in population and the growth in population. For example, in Africa and Kenya in particular, our people are very young. We have a very young population, but it's growing. What does that mean? And then lastly, think about the huge systemic transformations that are happening around the world that we're not immune to. Case in point, climate change. What does that mean for our market, and what role does an exchange like ours play to navigate those four things? Because no government no business, no individual is immune to those four forces. The change in tech, population, the changes, systemic issues around things like climate change, etc., as well as the global rebalancing that is happening between East and West. None of you here, including myself, are immune to those forces. So we too, as an exchange, are trying to say, what does NSE do in the context of those forces? How do we become relevant, successful, impactful in the context of those four forces? So to the extent that you have ideas that would help us become more successful in that context, we are very open to those. If you use, for example, our social media handles, you use our website and other contacts, you should be able to channel that feedback to us so then we can collaborate and make the NSE really the most successful exchange on our continent. Thank you and have a good evening.
All right. Thank you so much for the engaging conversation. It's been almost 2 hours, actually. I didn't expect us to go that long. We've also left a lot of questions. I can see a lot of questions below the pinned tweet. Our commitment is to make sure all those questions are answered. So we'll take them up and forward them to the NSE and get robust answers to them and send them to the various people who've asked them. So we've noted them. I think the interest in a lot of questions means that we should make this maybe a bit more quarterly so that you can come and be able to address people on some of the initiatives that you're making at the NSC. I think that would be really good. Even if you make it an hour session going forward, I think that would be really interesting. And then finally, of course, thank you for the audience, everyone who's managed to join us for the spaces today. Frank, thank you so much for making time. That's 2 hours of your time. We really appreciate that you're able to make time to talk to our listeners who are really interested in investing in capital markets. So I would say asante sana.
Thank you very much. Yes, please share through the questions.
Yes.
And our team will go through them, respond, and then we can get them back to the audience. Thank you again and looking forward to continuing to interact.